In this video, we're going to learn about the role of issuers and market makers. By definition, the issuer is the entity that's actually selling the warrants to the market. In order to be listed, every issuer is required to appoint a market maker for each warrant. This market maker then manages the issuer's own or proprietary positions, which is why the issuer usually chooses themselves or a related entity. Market makers provide continuous buy and sell quotes for their warrants on behalf of the issuer. However, there are instances where the market maker is not required to provide liquidity, such as when the value of the warrant falls below the minimum price of 0.001 cent, or when the underlying stocks or indices are closed for trading in their respective markets. For scenarios under which market makers will not provide quotations, just check the warrant term sheets available on sgx.com. Investors should note that the bid and offer volumes of warrants may fluctuate in relation to the bid and offer volumes of their underlying stocks. Investors should also note that offer volumes and spreads often reflect the willingness of an issuer to sell a particular warrant. For instance, if the offer volumes are small and the spread is wide, the issuer could be trying to discourage investors from purchasing that warrant. Now, there's a common misconception that issuers and their market makers always seek to profit at the expense of warrant holders by taking the opposite position. However, this is not true. The aim of the issuer is to capture profit on the risk management of warrants sold. When issuers sell warrants, they will normally buy shares or other derivatives to hedge their position and attempt to capture a margin whether warrant prices go up or down. For example, if an issuer sells a call warrant, they will often go into the underlying market and buy the underlying shares. Thus, if the share price increases and investors profit on their call warrants, the issuer will also gain on their shareholding. So instead of hedging against the direction of the shares, what an issuer is really attempting to do is hedge against changes in volatility. The volatility of a share measures how much its price moves up and down. The lower the percentage of volatility, the less volatile the share. The higher the percentage, the more volatile. There are two types of volatility. The first is historical volatility, which is retrospective and looks at the price changes of the underlying in the past. The second is implied volatility, which is forward-looking and refers to the expected volatility or change in price of the underlying during the life of the warrant. Issuers use implied volatility to measure the value of warrants and options, and also when deciding which option to buy as a hedge against the warrants they've sold. For instance, if they've sold a warrant with an implied volatility level of 25% and can then buy another option of similar terms at 23%, they would theoretically be making a margin or profit. This is how issuers attempt to profit rather than trading against investors. That concludes our 6th video on the basics of structured warrants. We hope you've enjoyed our series. For more educational resources and tools, just visit the Structured Warrants product page on sgx.com. And happy trading!